This is the Mobile Home Park Lawyer Podcast with Ferd Neiman. If you're looking to generate wealth and passive income in the lucrative world of mobile home parks, you're in the right place. You'll discover solutions to the common legal and operational pitfalls and how to optimize parks to maximize income. Your host is in the trenches. He's a real estate attorney, financial analyst, and mobile home park investor and operator. Now, let's turn it over to Ferd Neiman.
Welcome back, Mobile Home Park Nation. Ferd Neiman here again today with another episode of the Mobile Home Park Lawyer Podcast. Got another great guest for you today. He's an appraiser, which is near and dear to my heart because I love arguing with appraisers. No, I love working with appraisers, and I used to be Jackson County appraiser here in Kansas City, Missouri. So I got a little background in this. So it's nice to talk to somebody who's got even more background and more experience. So please help me welcome my guest, Chuck Schierbeck. Chuck, thanks for coming on, man.
Yeah, thanks. I appreciate you having me on. So,
Yeah, well, I know you a little bit, and I follow your newsletter, which is full of good information. So we can tell people about that as well, how to find you and all that here before we jump. But maybe tell us a little bit more about your background, how you got into business, and what you do today.
yeah. So I started in as an appraiser in 2001, and I actually started off as I started off with senior housing. The guy I first worked under did nursing homes, assisted living, CCRCs, stuff like that. And so did that for a couple of years, and then I switched over to work under Bruce Nell, who's the current head of our practice group. I've known Bruce since the 7th grade, so
Wow.
we sort of grew up together. I went to college at Ohio State and was actually a religious studies major. My plan was eventually to go on to grad school, but I got married a few days after graduating, and I never got back. Bruce had started working as an appraiser, and so I connected with him and just started doing appraisers with another guy that was actually a member of our church. So that's kind of how I got into it. When I switched under Bruce, he was developing a strong manufactured housing practice. And so from about 2006 on, through the recession and all that, we started, became a specialist in it. And Bruce rose up through the ranks, and so he's actually the largest producer for appraisal reports. He brings in the work. He's really good at selling it. So I'm currently the head of manufactured housing for the Midwest and Northeast. But we have our whole team is nationwide coverage. We have someone that works at the Pacific Northwest. We've got 2 people in California. We've got a couple people in Texas, someone in Florida that covers the Southeast. We got someone in Nashville that covers the other half of the South. So we've got this, what I think is one of the stronger groups for appraisals in the industry, because most of our regional heads are MAIs, which is highest designation you get as an appraiser. I'm an MAI myself. So
Great.
We started a different area, but switched over to MH, and along with Bruce, we've built a pretty strong national team. So
Yeah, no, I see you guys are active. I see you on LinkedIn and other places. You are always doing a ton of deals. So maybe tell us right now, for our listeners, it's March of 24. So we're in a pretty unique interest rate environment, at least relative to the last few years, where interest rates have gone up. How is that impacting your business and your clients' business as far as transaction volume? And how I've always kind of heard and followed that cap rates tend to have a lag behind interest rates. So if interest rates are up 250 bips, do cap rates go up 250, or they go
no,
less for certain assets? How's that all
so
working today?
There's a couple of like counterbalancing forces. Interest rates have sort of tamped down things a little bit, and even cap rates have gone up over the past couple of years. So that's a pushes down value. But the other thing is that, since, well, I mean, it goes back before the pandemic, but I think a lot of people in the pandemic realized, all right, the people own the homes. So of all your renters out there, the people that are most likely to continue paying rent are those people that are invested in the real estate in some sense. So, um, when you look at that against other things that were considered locks in real estate, like, triple net retail and things like that, that had suffered during the pandemic as well, there was what was a heightened interest even increased. So after the pandemic, for the next couple of years, you had a lot of people getting into the industry. So all of that money and interest has sort of pushed down cap rates. We'd be even, I'd say up until early 2022, every few months I would say there's no way cap rates can get any lower. I mean, it's insane. So there's, in that sense, manufactured housing is beating the average. But certainly things are, cap rates are higher, values are lower than what they were year and a half ago, even.
So what I've kind of seen, tell me if you disagree, but you look at it a lot of markets yourself, but what I've seen is interest rates have gone up by, a sizable margin, but for manufactured housing, because of the stickiness of the tenant base, because some of the underlying fundamentals, the asset class, cap rates have gone up some, but not as much as interest rates and not as much as some of the other asset classes. Is that a fair assessment?
100%. That's right.
Okay.
So
great. Now, so you made a comment a minute ago, and I think we've all made this comment that, man, can cap rates get any lower? Or they're kind of insane. But obviously, if a willing buyer and a willing seller transact at that price, that is the market. How much do you look at market comps versus, your own other analysis or opinion? And how does that change from time to time, if at all?
Well, yeah, I mean, so there's several different ways we look at cap rates, developing them. One is market comps, and that is overwhelmingly, like you said, I mean, the definition of market value is a knowledgeable buyer and knowledgeable selling come together. That's the strongest support. We will also call around to brokers. If you're a subscriber to the newsletter, I put out a weekly rundown of what's listing in the market. So we look at current listings. That's an important factor. And then there's financing techniques. There's band of investment and debt coverage ratio techniques that get there. Now those are kind of diverging from some of the other sources because of the factors we already discussed. But those are the things, and the market comps are the number one thing that we look at. So
how has the market changed as far as, I mean, what percentage is volume down, if you have that statistic, or days on market? I mean, I know I recently saw a deal that I thought was overpriced by a ton. I'm like, this is overpriced even at the peak of the market, and apparently it was, because I offered like 70 cents on the dollar, and I was like, this is a low ball offer, and the broker got back to me and said, you're our selected buyer, but they wanted me to go another $2 million. I was like, well, I'm not going to do that. But they told me that nobody else, at least no credible buyer, made a bigger number than me, and I was 70% of list. So that, I don't know if it's going to transact or not. My gut is no, because we're so far apart. But there's seemingly still a disconnect where sellers want yesterday's prices, but buyers can't get yesterday's loans, so you can't pay the same price you could a year and a half ago.
Right. Yeah. No, the sorry, what was can you restate that question?
Just what are you seeing on transaction volume?
Oh, yeah.
In particular.
So yeah, I would say, early 2022. I think when we started towards the end of 2022 on into 23, we sort of stopped looking at sales older than um, June or July of that year. Anything before that, we just sort of put aside because we wanted to see what was going on. Prior early, pandemic to 2020, early 2022, it was 3 months or less was sort of our marketing period for these
Okay.
things. And I would call brokers and say, you know, I've not done my job if it's all the way up to 3 months. I think you're getting to we're putting more like 6 to 9 months for that sort of time period. So it's certainly there's a disconnect to a certain extent between buyer and seller expectations. So and it certainly slowed down things. I did, there was a point in 2022, 21 and 22 where I was doing I was averaging 10 to 20 appraisals a month, and now I'm 5 to 10. So it's
Got it.
in terms of that factor, it's my business is half of what it used to be. So
Yeah, I see it a lot in the market too. I mean, the same thing. A lot of our law clients, it's like guys that are really active. I'm like, I haven't heard from you in 6 months. Did you replace me? He's like, no, we're just on the sidelines. Like, okay,
yeah,
want to make sure. Um, let's talk about variables that impact value. So I'm going to give you a hypothetical park. We were talking earlier.
okay,
You appraised one of my parks in the past in Quincy, Illinois, my hometown. So let's assume just pick one. 50. I sold this park, so we'll pick this one. 54 sites in Western Illinois, city water, city sewer, mostly tenant-owned homes. So say 90 to 95% tenant-owned homes. What kind of cap rate? Um, let's 3-star park. Decent park, paved roads. Mostly single wides, but 80s and newer, 80s, 90s. So vinyl siding, shingle roof. What kind of cap rate does that look like in today's market? And then I'm curious to see what that would look like, in the past, what you think it'll look like in the future. And then from there, we'll look at variables such as modifying utilities and occupancy and so on.
yeah. So I'll pull up something here real quick. I put together um a newsletter that we're going to hand out at the manufactured housing event um, next week, and I kind of put together where we see cap rates coming in at.
Yep.
So and so these are, we sort of break stuff into um sort of quality classification. So 4 to 5 star class A uh properties. They also tend to be larger communities. You're probably looking at um you can on stuff like that, you could look at 4.5 and under, maybe getting down even under 4 in some really nice markets like Florida, California, stuff like that. For uh class B properties, you're probably looking at somewhere between 5 and 6.5. Some of the, if it's in a major city, if it's how many home sites it is a factor. The potential of the market is a factor. Um, occupancy, upside is, I guess, the best way to put it. Occupancy potential increase, rents potential increase. Those are probably
So you'll give a lower cap rate and thus a higher value if there's upside in the rents and the occupancy, as opposed to going off current NOI.
so it depends who we're doing it for. So Fannie and Freddie, which is who I do a lot of stuff for, they will not let you look at, leasing up the property and taking off the cost to lease it up. That's one way we would approach it. So if you're looking at that, the only way you can really quantify that upside is by putting it in the cap rate. So the and then when you get to Class C, and for us, Class B is probably the largest classification. It's 3 to 4 star. Anything under a 3-star property we consider Class C, and those would be, they might kind of merge into Class B range if they were in a really nice area, but other than that, you're probably looking at 6.5 all the way up to 12 if it's bad location, old homes, stuff like that.
Okay, now what if it's a nice, like I have one park in particular, it's a nice park, nice market, but I have private sewer. I've got septic. Are you gonna decrease my value a little based on private utilities? Or are you gonna just have if that expense is already included in the operating expense, are you gonna not ding me?
I may not necessarily reduce for that, and that's because it's a consideration. I think a lot of owners have figured out how to deal with that.
Right.
It's you want to do your due diligence and make sure that your septic system's operating properly. But if it's in good shape, it would be a bigger draw or a bigger, you know, downtick if it was, 5 to 10 years ago. I mean, but I think most major owner operators have figured out how to work that in. I mean, if it's not, on city water sewer, is that because it's way out in the country and it's hard to get to? That then gets into more the overall quality of the community. But if it's a nice community and it just happens to have septic or well water, um, as long as there are no as long as it's in working order and there's no environmental concerns.
Got it.
But on a that's sort of a case by case basis we got to figure out.
Now,
And
what do you,
I've
oh,
seen
go ahead.
some crazy environmental issues on some
I
properties.
bet. Yeah,
Yeah.
those can get pretty gnarly. Now tell me about home site count. What are I know for like Fannie Mae, typically 50 sites is a kind of a magic number for that quality of financing. Is a 49 site park only one worse than 50, or is it basically like 5 worse or 10 because it doesn't hit the 50? And then are there other metrics beyond, say 50 or say 100? Is a 39 site park basically the same as 40, or is it where are those breakpoints?
You do get below certain breakpoints where you're um where there is a downtick. But I don't think necessarily part of the problem for me is that most of what I do is Fannie and Freddie, so I'm not
Yeah.
necessarily seeing those smaller communities. Although I do see them when I do a couple of year-end valuations from larger owner operators, and they'll have one or two. Uh, uh, one of the owners I work with, Kurt Keeney, he calls them pocket parks.
Hmm.
These little tiny little things that he usually acquires as part of, he's buying. He bought like a 200 site in southeast or southwest Louisville, and he got 5 pocket parks with it. So, um, I think, um, you know, oftentimes I'll see those. Um, I'll see somebody buy, 225 ciders that are close to each other and run them as one property, and
Sure.
that mitigates that factor. Um, but yeah, no, if you've got a 10-siter, it's that's certainly less than that. That's less desirable than a 50-siter. The smaller you get, the more it's not a national owner operator dealing with it, and then there becomes a variety of factors. The cost and upkeep, and you know you sort of lose some of the economies of scales that you get with larger communities, and the smaller you get. I don't know a specific price point, but certainly 10 is not as good as a 40. So
Right. And on a part of that economy of scales, it's hard to, you've got a 10-site park, it's hard to hire a manager, right?
right.
You can't afford a good manager, or, or at least not a high paid manager. So, I mean, tell me, what do you see on expense ratios? I've had numbers float around for years. And then, I know at Frank Rolf's boot camp, he used to say, it's 30%. If the tenants are paying the water sewer, it's 40. And obviously that number, if the water's free, but that ratio is going to be
Right.
different if it's 10 sites versus 110 sites, and obviously your tax burden and a number of your top line rent and all that impacts. I'm just curious, like, what do you see in the ranges? I had one park, for example, I sold, they had 22% expense ratio, and the broker that listed it told me, oh, no one's going to believe that, we're gonna underwrite it at 35, and that really hurt the value. I'm like, but it really does have 22. They could, I'm telling the truth. So they basically underwrote it at 30, and that's the best they would give me, even though it was for the listing, at least, even though it really was 22. So how do you look at that, and what's your experience with that?
Well, yeah. So the you know 2022 is not um that does not surprise me. I have I've seen a lot in that range, the 20 to 35, which would be considered lighter. But I would say, and I actually have some numbers here. Your the data we have on Class A properties, and this is mostly in the Midwest, is actually 26%
Okay.
as an average. Class B, the average, Class B and C are the same, and the data I have at 34%. So typically, the typical range of what we're seeing is probably that. Um, I know some owners that run pretty light, and I know some owners that run pretty heavy. Um, Different philosophies in different parts. There's some people that will, insurance is one area. I got one client that'll insure electric lines running into a community. And then I know one owner who will tear down a clubhouse and put um a double wide in as a clubhouse. Um, Better call it a multi-section. It's not like it's a decent, it looks as nice as any clubhouse, but he doesn't have to insure it. So it's just different philosophies. And then all of a sudden going low on that. A lot of people, it's one same owner has in one community, they use they have their own personal, they have their maintenance people go around and collect the trash and then put it in their dumpsters, and that saves them a considerable amount. So you can get pretty tight on these things, and not if and I would have the expense comps to prove your rates, which is we mentioned this earlier. It's a reason to go with an expert, and in manufactured housing, because we've seen almost every scenario, right? How in those smaller communities, um, on-site management may be just one of the residents. Everybody's responsible for taking care of maintaining their site, and you just pay an on-site manager to collect rents, and you're
Right.
just paying them you're just paying them free rent, right? That's their, and so it's the rent of a property times 12 and a rent of a site times 12, and that's your expense. I did one community in Buffalo, New York, where it was a 55 plus community, all multi-section homes, almost class A, and that they didn't have any common areas to maintain though. I mean, everybody was just happy to have a really nice home with an affordable site rent. And I met everybody, and the owner of this multi-section that was this 75-year-old lady that was sweet as it could be, and she was the manager of the community, and all she did is collect rents and or collect checks, and so you yeah, they were decent rents. I mean, it was the expense ratio was very low because you had very low management, so very low maintenance too.
Yeah.
So yeah, I mean, it's a part of it's just being able to tell the story of why stuff is that low and having the data to back it up.
Okay, makes sense. Let me ask you about park-owned homes. How do you value those? And do you put a different expense ratio on them, different cap rate? Do you capitalize the NOI, or do you look at shell
So
values?
so in terms of park owned homes,
Yeah.
we don't typically value them directly. We will sometimes evaluate the impact they have overall in the community. Um, Although, you know, the when I was starting out, people were very reticent to have a lot of community-owned homes because um, you didn't have that factor I mentioned earlier where people are invested, right? And so that was a concern, but it's a lot less of a concern anymore. You've got major owner operators whose model is to bring in a bunch of homes and rent the homes in sight. Um, most of the most lenders won't lend on it. When they do, that is something we do is we value them, and we just sort of we look at them a variety of ways. One, um, there's a variety of cost source reports. There's NADA, which I've used before. I've got Marshall and Swift, which is another valuation source. It's less accurate, but if um, you know, sometimes it's not as important to be down to the dollar on what the house is worth, and the client, and it's not a value issue. I'll use Marshall and Swift. Um, so there's a couple of just cost approach ways. Sometimes we'll include it in um, the regular, we'll put it in as the homes and the expenses as a line item. And then what we'll do is we'll try and determine the difference between the cap rate on the homes versus the home sites. And that can range anywhere from 5 basis points or um, uh, 500 basis points to 0 basis points. We and the key difference is Wells Fargo had a program, and I don't, they've not called us to do any more work on it, so I don't know if they're still doing it or not. But they had a program where they would value everything, and we use the same cap rate. The difference is that they were able to get the homes classified as real estate.
Interesting.
There's a part of the tax code that we used that defines whether or not you can count for a tax deduction a manufactured home as real estate or personal property, which um, impacts how you can deal with it from a tax standpoint. So we use that classification to say this is real estate because it meets these criteria. Um, And the funny thing, upon reading it, it was like most of the home sites that I'm familiar or homes that I'm familiar with are cited in this manner. So like you could make an argument that most home sites are real estate. But not a lot of people do. And then when we were doing it that way, I think we there was a difference between older and new homes. I think it was just in the rent. I just think that was we still use the same cap rate. But typically, we're probably closer to the 3 to 5% increase over the going in rate or going over the real estate cap rate. And then what we do is we take the percentage of the income stream that each is, and we multiply that by the cap rate, and then sort of get a weighted average. So that's one way we do it. And then another is we just isolate, we throw in the addendum, here's the value of the community owned homes, here's the income and expenses, and here's the cap rate we're using. But it's a higher cap rate because if we're viewing it as personal property versus real estate, then there's a lot more risk to that, if that makes sense.
Okay, makes sense. Now, let me ask you this. What mistakes do you see buyers make? Anything come to mind with that, buyers valuing something at X and then you get involved and you're like, no, it's really only 0.7x and you're upside down. Anything that the buyers in the marketplace tend to make mistake on, or buyers pretty savvy and generally have a similar valuation that you have?
The buyers that we're working with are generally pretty savvy in terms of how they're evaluating things, more so um, than than mom and pop owner operators that have had the property for a while. The mistake I would see from maybe a small owner operator that's not as active in the market is that um, they're not increasing rents as much as they should. They're not. Some smaller owner operators are probably operating at 70% or below occupancy because they're not taking the time to figure out how to bring in homes and sell them. So, mistakes that a buyer could come in and make, times when we've seen, times that we've seen things, even experienced buyers, I would say is, if you've got an equity partner that you're working with and that equity partner is unwilling to, I guess finding the right equity partner, if that's the situation that you're in, is important. If you're buying something for upside, you've got to have the ability to buy homes and bring them in. I mean, you gotta increase occupancy. Another concern is the area you're going into actually an area where you can increase occupancy? So are you buying something where, I've had people talk about there's one property up in Flint, Michigan that I've appraised multiple times. And each time, and this is like over the course of a decade, each time somebody was convinced they were going to bring in homes and lease it up. And each time I go back to appraise it again, it is the same occupancy. And I don't come to think of this particular property, I don't remember going back and seeing, new homes, right? Like it's still the homes that were there. So I'm not always privy to what the breakdown was. But I know some major owner operators where they're looking at different equity partners because they want someone that can partner with them to bring in homes. And I mean, you got to be able to bring in homes and finance them if you're going to capitalize on the upside. So that should be a consideration going in.
I don't know. You mentioned earlier there's some big operators doing the park owned home model. So that being the more of the new wave, is there much difference in value or cap rate if I've got a 50 site park with 40 park-owned homes versus 0 park-owned homes. Is it, are those the same nowadays? Where I feel like in the past, the park-owned homes were seen as a liability a little bit.
The park-owned homes have been seen as a liability, and I think larger owner operators even reach like ELS and Sun. I mean, they're getting to, I don't know the exact amount, but I've understood that they've gotten up to 25% park-owned home in some of their communities. I don't think they're doing 100%. And I think the strategy generally with people I think people are starting off with community-owned homes, and then they're phasing them. They're trying to get the people to become buyers.
Sure.
So, but if you've got a 50% occupied community, I think bringing in a bunch of community-owned homes and or a bunch of homes and renting them, it's kind of a way to kind of prime the pump on getting that community leased up, and then you can deal with switching it over. But I mean, there's still a lot of reluctance in the industry from people on those sort of communities. But part of it's the market you're in. So like I mentioned Flint earlier. Flint is a sorry for the noise, something going on the street. The Flint's a rental market. Houston, Texas is a rental market versus Dallas, which is a buyer's market, right? So stuff like that, those areas, it's we have a team in Houston, but a decade ago when I did a couple of communities in Houston, and they were super nice communities, but they were rental. We're seeing more of that. There's a developer that I was made aware of in West Virginia that wants to do it's essentially the build to rent phenomena, I think is coming along stronger, and I think because of that, a couple of people are wanting to do that, but with manufactured housing. So that's, I think, just kind of a different perspective or way of doing things. I don't necessarily know that it's gonna, if you're just valuing the home sites, if you've got a bunch of new homes in there, and you got the right operator, I wouldn't necessarily ding the value, and I haven't. Cambio is the one that I know that's had a strong rental program, and their previous company sold to Sun. I think it was to Sun or Yes, I can't remember right now. It sold at the same cap rate as something that wasn't that heavily rentals.
Right.
So yeah. Yeah. And that's another factor in value too, is there's been a couple of large portfolios that have traded over the past couple of years, and those are, if you're looking at those for comps, they're almost different rules, because there's a lot of people that want to like jump into the industry with both feet, and they will pay lower cap rates to get portfolios of the
Right.
size.
There's certainly a portfolio premium. You get jumping with significant scale. I mean,
Yeah.
at least 1,000 sites, but some of these guys are buying 10,000 at a time. It's unbelievable.
Yeah. No, you're aware the Moore portfolio that recently traded?
Yeah.
Yeah. I think they just closed on it. The Crow Properties ended up putting a press release out as
Yeah.
the
Crow
buyers.
Properties I saw last week bought 10,000 or so sites. Are they the ones that bought the Moore portfolio?
That Well, yeah, no, it's the same number of properties in the same states. So
Okay.
it's 46 properties. There's not that many 46 property portfolios in that same set of states. So that's got to be that transaction. I don't have 100% confirmation, but I'm pretty certain
Yeah.
that's
Yeah. Big
the
number.
buyer.
All right, Chuck. Well, got a couple minutes left. Anything else you want to share? Any tips or tricks for our audience, or if not, where can people find you?
No, so if anybody's going to MHI, our booth number is going to be 200. Feel free to stop by. You can find me on LinkedIn. Happy to connect with, or just search. It's Chuck Schierbeck, last name Schierbeck. You can find I put a daily newsletter out, different topics each day. You can find that at realestatesolutionist.substack.com. And my two popular posts are Tuesday and Wednesday. Tuesday, I put out MHC listings. I go out to all the brokers and put a listing of their sales. I do the same thing on Wednesday, but with RV. So be happy for anybody to check that out. That's how to connect with me.
All right. Sounds good, Chuck. Well, I hope to see you in person next week, and thanks for coming on the show.
Okay, thank you.
Got it.
You've been listening to the Mobile Home Park Lawyer Podcast with Ferd Neiman. Ready to learn more? Go to www.themobilehomelawyer.com for free resources and materials to help you succeed. If you love the podcast, go to Apple Podcasts, give us your review, and subscribe today. Thank you for listening. Neither the Supreme Court of Missouri nor the Missouri Bar reviews nor approves certifying organizations or specialist designations. The choice of a lawyer is an important decision and should not be based solely upon advertisements.